Context is king when you're looking to place a trade. You see, the single biggest lie new traders tell themselves is that a candlestick pattern is a strategy. It is not. I see traders every day looking at a bullish engulfing candle or a hammer and hitting the buy button immediately. Then they wonder why the market rolled over and crushed their stop loss. The reason is simple. You're reading the words, but you're ignoring the sentence. You're looking at price action, but you're ignoring market structure. And without structure, price action is just noise. Today, I'm going to show you why your patterns are failing and exactly how to fix it by putting structure first. Let's get started. You see, I want to know the difference between the map and the vehicle. That is a critical distinction we're making today. Market structure is a map. It tells us a destination. It tells us if the dominant force is buying or selling. It is a framework of higher highs and higher lows on the higher time frame charts. Price action, on the other hand, is the specific movement of candles, the pin bars, the wicks, the engulfing patterns. These are just the signals. The problem is that most people try to drive the car without looking at the map. They see a green light, a bullish candle, and they step on the gas, even though the map shows they're driving straight off a cliff. In this video, we're going to break down the hierarchy. I'm going to show you how to identify the structural bias first. That is when, and only when, we look for the price action trigger. If you get this order wrong, no amount of risk management will save your account. Let's talk about why price action fails. You see, a candlestick pattern represents momentary battle between buyers and sellers. That's all that it is. If you see a long topping wick on a 5-minute chart, it tells you that for a brief moment, rejection happened. But it does not tell you who is doing the rejecting or if they have the money to sustain it. New traders love patterns because they're easy to spot. A doji is visual. A hammer is visual. It feels actionable, but statistics show that raw price action patterns taken in a vacuum without structural context fail between 60 to 70% of the time. Think about that math. If you're trading raw patterns, you're restarting with a probability disadvantage. Why does this happen? Because a bullish signal is in a bearish structure is not a reversal. It is usually a liquidity grab. Look at this chart. We have a clear downtrend. We're making lower lows and lower highs. Right here, we get a beautiful bullish engulfing candle. It looks strong. It closes near the high. Novice traders see this and think, the buyers are here, and they buy. But context is king. This bullish move wasn't a reversal. It was a pullback to gather more sell orders. The structure was heavy, the trend was down, the price action lied to you because you didn't respect the structure. That is when I am looking to sell, not buy. I want to see that bullish candle fail so I can join in the real move. So, if price action is a trap, structure is a safety net. I want to know that on the higher time frame charts, like the daily or the weekly, that the market has a clear direction. We define this through the sequence of highs and lows. In a bullish market, we will see higher highs and higher lows. In a bearish market, we will see lower highs and lower lows. Let's look at this recent weekly chart of the S&P 500, and I will demonstrate how right now the market is in a bullish trend because we are continuing to make higher highs and higher lows. Let's focus on the most recent pullback and the low that was established here. As long as any pullbacks, we do not make a lower low than 65.25. The market will remain in a bullish trend on this weekly chart. Now let's look at what a potential reversal would look like or a change of character. You see, I want to know when the stairs break. Imagine walking up a flight of stairs, higher high, higher low. Suddenly you step down and you break the previous low. That is the change of character. That is the first real sign that the structure has shifted from bullish to bearish. When I see a change of character on a daily chart, my entire mindset shifts. I stop looking for reasons to buy the dip and I start looking for reasons to sell the rally. This is the where. Market structure tells you where the market is going. It provides a directional bias. Without this, you're just gambling. Now we bring it together. We know context is king and we know that structure provides a direction. So how do we use price action correctly? We use it as the trigger. I want you to think of it like this. Structure tells us what to do, to buy or to sell, and where to do it. At demand, I want to be a buyer, and at supply, I want to be a seller. Price action tells me when to pull the trigger. Let me explain how I find the demand zone and the supply zone. For a demand zone, or where I want to be a buyer, I first scout for an inside candle followed by a large candle that moves to the upside. For a supply zone, or where I want to be a seller, I again scout for an inside candle followed by a large down moving candle. Here's the checklist that I use. First, I identify the trend on the higher time frame. Let's say we're in an uptrend on the daily chart. Second, I identify the structural zones or the demand and supply zones. I am looking for the inside candle followed by a large move to the upside for a demand zone and the downside for a supply zone. I mark those zones. Next, I wait for price action to bring price into my zones. I use these zones both as an entry and an exit for my trades. Now let's not pretend. The waiting, that's the hard part for many traders. But wait, that's what I do. I do absolutely nothing until price reaches that structural zone. In this case, the demand zone. That is when I'm looking at the price action. My alert goes off that price has entered that demand zone and I'm watching that price action on smaller time frame charts to give me the confirmation I need to be a buyer in the demand zone. Why? Because now that the price action is aligned with the structure, the signal matches the map. When you have a structural reason to buy and price action signal to buy, your probability of success skyrockets. Confluence equals confidence. You're no longer guessing. You are executing a plan based on evidence. Trading is not about catching every move. It's about catching the right moves. You see, I want to know that the odds are in my favor before I risk a single dollar. By forcing yourself to identify the market structure first, you eliminate the impulsive trades that drain your account. If you want to go deeper into exactly how we identify these supply and demand zones, I have some big news. I'm partnering with Trendy Trading, Trendy John, for an exclusive supply and demand 2026 evolution class. We're going to drill down on risk management and discipline to help you master the art of supply and demand trading. Check the link in the description for details. Remember, context is king. Protect your capital, follow the structure, and I will see you in the next video.